Lumber prices are falling, housing prices are increasing, and the inventory shortage could soon be coming to an end. We've also got 2 million homeowners that are in forbearance, and this program is coming to an end at the end of this month. So how is the housing market doing since last week? Well, in this video, I've got all of the updates that you need to know about coming up now. The housing shortage may finally be coming to an end, at least for now. Inventory of homes actively for sale in June decreased by 43% year over year. This was a lower rate of decline than in May, which was 51% year over year. This means that inventory has increased by about 8% in the last month, which is a great sign for home buyers. More inventory on the market is going to help slow things down in this real estate market. In June, we saw new listings increase by 5.5% year over year. However, this number is still down by 14% when compared to normal years of 2017, 2018, and 2019. We've also seen the median home price for active listings increase to $385,000 in June. This is a 12.7% increase year over year. And this rate was lower than the month of May, which we saw at 15%. This was the second month in a row that we've seen a decline in rising home prices. Another great sign showing that the housing market may be finally slowing down. Austin, Texas saw the highest growth of 34% year over year. Next up, home sales continued to rise in May from April. As we are getting more data for home sales from previous months, we have seen an unexpected increase in the month of May. Pending home sales from May increased by 8%. The expected number was a 1% decrease month over month. The number of pending sales was the highest level in the month of May since 2005. Sales were also up by 13% over May of 2020. This is when the housing market was just starting to recover after the pandemic started. And another factor in the inventory has been sales of new home construction. Sales of new construction homes fell by 6% in May from April. This was in part due to builders having to raise prices to cover the increased cost of labor, land, and materials such as lumber. Newly built home prices soared by 18% from the month prior. So that shows a huge increase in cost to buy a new construction home, which were already expensive to begin with. But lumber prices are coming down. Even though wholesale lumber prices have tumbled to $764 per 1,000 linear foot, they still remain 2.5 times higher than pre-pandemic costs. And much of the decrease in lumber prices have not even yet been felt by consumers. So we've been seeing wholesale prices tank, but we've not seen the same for retail prices. Building materials as a whole are expected to continue falling in price through 2022, but may not reach pre-pandemic levels until 2023. And I don't even actually think that we'll get pre-pandemic costs ever again. Next up, weekly mortgage demand has fallen by 7% this week. Because of the record high home prices over the last few months, we are finally seeing buyers slow down on their buying sprees, many of whom are waiting for the real estate market to cool down when they may actually be able to get a house for a good deal. And as I mentioned, weekly mortgage demand fell by 7% this week, with mortgage applications to purchase falling by 5% this week and overall down by 17% from the year prior. We have also seen that the average loan amount to purchase a house has increased. This indicates that first-time home buyers who typically get smaller mortgages are getting squeezed out of the market due to lack of inventory for homes in the entry-level market. Rising interest rates have also contributed to an 8% drop in refinance applications. This number is also down by 15% from the year prior when the interest rates started tumbling. We saw interest rates for a 30-year mortgage increase to 3.2% from 3.18% last week. And keep in mind, we started out the year with rates at 2.85%. So we've been seeing a significant increase in interest rates, which is also contributing to the slowdown in the real estate market. And alongside home prices increasing, we are also seeing rental prices start increasing as well. This is showing that after rents got clobbered in the year prior, with the economy opening back up, rent is starting to make a rebound. They are catching up with the massive increase in real estate prices over the last 18 months as well. The median apartment rent increase increased by 5.7% in the month of May. This is also the third highest rate on record. But this was to be expected since real estate prices have increased so significantly over the last 18 months, there's no way that rent wouldn't have increased as well when things started opening back up. And finally, forbearance applications are coming to an end at the end of this month. Through the pandemic, we saw roughly 7.25 million borrowers take advantage of forbearance programs at one point or another. This number represents 14% of all homeowners in the United States with a mortgage on their home. There are about 28% or just over 2 million people still in forbearance programs as of this week. In the last week, 146,000 plans were reviewed and 44,000 left forbearance, while the other 102,000 remained on the forbearance plan. And by September, we're going to see the first wave of about 575,000 people who took forbearance last year coming to an end. Remember, you could only stay in forbearance for a maximum of 18 months. This means that they're going to either need to start making their mortgage payment, sell their home, or face foreclosure. But I think it's pretty safe to say that the foreclosure level is going to remain very low because of the increase in real estate prices. Most people would just be able to sell their home and get out of it and make a profit. And that's another reason why we're not expecting to see a foreclosure crisis anytime soon. Back in the 2008-2012 timeframe, there were about 11 million homes in foreclosure. So that number is obviously going to be significantly less, if not near zero. So this means that mortgage services are going to be reviewing about 15,000 loans per day. With the latest guidelines from Fannie Mae, Freddie Mac, and the FHA, they are hoping to find a way for as many homeowners to stay in their homes as possible. Whether it's through modifying their loan, getting a lower interest rate, or moving the missed payments to the end of their mortgage, rather than having to pay it back immediately or within a certain time period as previous guidelines would have required, they're putting out guidelines that are allowing lenders to relax a lot of these requirements. So they're hoping this will have a small impact on the real estate market. And so that's my update for this week. Check back Monday for my next update.